And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Anytime you're talking about fundamentals in a market and direction, fundamentals take a little bit of time to play out.
We got crude oil today, kind of trading yesterday's value area really nicely, low to high.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Good afternoon, friends and traders. Welcome to Limit Up Podcast. I'm Dan Hodgman, sitting down with Jack Peltzer. Jack, how are you?
I'm doing well. Happy St. Patrick's Day, Dan. I was going to bust out the Guinness for this, but I figure I'm going to wait until at least 5 or 6 o'clock.
I put on a green sweatshirt. It's just not showing well, but I swear it is green. I am Irish. I wanted to point that out. I swear I put on green for St. Patrick's Day. It just doesn't come out on camera like it's green.
Yeah, I forgot about it. I have a green shirt on, but that's completely by accident. I didn't realize it was St. Patrick's Day until about noon. But nevertheless, I too am Irish, so it's a good day just to bask in that minimal.
I'm kind of bummed about it. Annually, we all go to my parents' house for St. Patrick's Day. My grandma's straight over from Ireland, and so my mom's got her recipe for corned beef and cabbage. They're out of town this week. I'm really disappointed that the whole family's not going over for green beer, corned beef, and cabbage, but we're going to survive, I guess.
Yeah. Well, my wife, who spent 6.5 years in Dublin, is ordering Irish takeout tonight. So we'll have that.
Oh, there you go.
Yeah.
There you go. Awesome. Well, let's talk these markets real quick. Kind of do a rundown. I'm going to talk about crude oil last as opposed to first. We're going reverse order. Equity or Treasury is really relatively quiet after the number yesterday. Today was really a quality inside day. We saw the market kind of established a high in the overnight session. We opened up this morning. We rallied right up to that high and closed the gap down to settlement price. When we talk about looking for that closing the gap to settles, that's really what you want to look for. You want to watch that market start to approach a key level away from settlement price. Look for a reaction at that price, and then you can take that move to the downside. Euro pretty quiet there. Gold, though, got a nice little lift yesterday on Fed raising rates. Continued with that trend all last night. This morning, we started higher, gave up a little bit, but still in a nice channel to the upside. Equities, though, pretty quiet here. Kind of quite the reaction yesterday. I know everyone kind of factored in rates are getting raised, and we've seen a down market in these equities for the last couple of weeks. But we got a nice pop after it kind of reacted, sold off. We pulled down to settles yesterday, a nice bounce there. And then today we're seeing a little bit of a light uptick.
Yeah. And I think we'll get into that move later, because today our topic du jour is talking about trading in a rising rate environment. And specifically, we'll talk about the Fed yesterday. We always say with something like the Fed, you got to do what the market is showing you, not what you're basing your armchair quarterbacking on the reaction to some news event.
Mm-hmm.
I really wanted to break that yesterday and buy that dip because I did not understand why it was dipping, and we'll get to that later, but continue your rundown.
All right. The last one, it's been the hot topic for the last few weeks, maybe even the last month or so. Crude oil kind of took that big run last week. We saw $130. Then we saw a little bit of a sell-off. We were getting optimistic about that, myself included. I like seeing yesterday settle below $100 for the first time in a few days. Well, that market now back well over $100, $103 a barrel. So we're seeing about an 8-9% move to the upside in that market. I don't think it's anything to say, hey, the rally's back on, the rip to the upside is going to continue. Got to keep in mind what the ATR is doing, right? What's that true range of these markets? These markets have been ranging pretty heavily in the crude oil. And we're going to see this for quite some time. Still uncertainty out there. I'm hopeful that it comes down, but we're just going to trade what the market's given us.
Nice. Well, it's good to see the oil report back at the top of everyone's mind. That's not a market that I've been following until the last couple of weeks, but it's back above 100 today. These ranges are insane, by the way. I see it's up $8.32 today. That is a large move considering, it was $45, $50, $55, $60 a barrel not too long ago. So
it's funny, Jack, I was actually looking at some of like my past stuff on Instagram, and I saw like an old story I posted 2 years ago. Exactly 2 years ago, I paid 99 cents a gallon for gas. And when I fill up tomorrow, I have to fill up. I'm going to be paying probably about $4 here in Wisconsin, a little bit cheaper than Illinois.
well, I guess that's what you got to do to drive that big old truck, Dan.
Right? The price I pay.
Yeah. So before we get started with the Fed stuff, just want to remind everyone you can fill out a bracket through Friday. Can't fill out any more brackets for March Madness, which I have a Vicarious TV on in the background here. I didn't watch too much basketball this season. Well, it's too late to fill out your bracket for that, but we're doing Top Step Market Mania right now, where we kind of do a bracket that, according to our legal department, has nothing to do with March Madness. You just pick the futures products that will win each day, winning defined by doing better than the other product. So have till Friday to do that. With that plug out of the way, the Fed yesterday. I'll start by talking about what they did and through the lens of equities to start. So the Fed raised the discount rate by 0.25% yesterday. People have been expecting the Fed to raise to fight the inflation for quite some time. And it was 100% certain, basically, that they were going to raise by 1/4. The only question was, would they raise by 1/4 or 1/2, and how much dissent there would be to the decision on either of them. Okay, I'm setting the table here, Dan, of why I was very confused.
The forks and knives out.
Yeah, we've talked in the past. This is anecdotal. I haven't gone back and broken down the data, but it seems like the original rip move after the Fed is always wrong. I don't know. Maybe I just remember those more than anything else, but I feel like it always rips one way and then comes back and more the other way. So the odds of them raising by 1/4, which they did, were baked in 100%. They were going to do that, right? There was the outlier case was that they're really spooked by inflation and they were going to raise by 1/2. And that would have, just because all the markets are about expectations, that would have tanked stocks, right? It'd be unexpected. Or that it would be 1/4 with significant dissent. Now, what ended up happening was they raised 1/4 and only one board member dissented. Bullard did. And he dissented because he wanted to do 1/2. That was his opinion. As far as I can tell, I think that's what created that initial move, that there was a dissent. But at the end of the day, it was still just 1/4 point. And given that the market was up, 400, I'm thinking NASDAQ right now, just because I remember that number was up like 400 points going into that number or thereabouts. And I think ripped all the way back to close to break even. And then I think people started realizing it was just 1/4 point. That's what we expected. Shouldn't change too much. And then it came roaring back. Now comes the fun part, where Goldman Sachs, for instance, is expecting, I think, 11 more raises between now and the middle of 2023, including 1/4 point at each of the next 6 meetings that they have this year, the final 6 meetings. So I'll stop talking for a second, Dan, and let you give any thoughts, and then we'll dig into this a little more and how you can trade it.
Yeah, absolutely. Well, first and foremost, just kind of what Jack's talking about here. It was 100%. Everyone knew this was going to happen. Whether ever anyone wanted to say ahead of time, I guarantee this will happen. They're going to play the odds, It's like making a pick, but we all knew this was going to happen. The markets knew this was going to happen. So when you see that initial sell-off coming in, that's where you have to kind of lick your chops a little bit and get kind of excited for a good opportunity. It's not to take that short. It's wait for this market to start to react, because news is always baked in ahead of time, right? We saw it with equities prior to Russia going into Ukraine. That started to bake in. Obviously, it spilled over and kind of continued into that downside move. You started seeing oil creep higher. So a lot of this news gets baked in. And I believe most of the time when you see that initial reaction, that's the emotion of small time frame traders, not the big institutions. Those are the ones that are sitting there freaking out, thinking, okay, I got to get out of my trade because this thing's going to tank. Because fundamentally, it tells us that if rates go higher, look for stocks to break down, because it leads to potential other concerns down the road. Well, that's all been factored in. The big institutional people knew that that was going to be the case. And therefore, you as a trader really need to recognize this when the Fed comes out to speak, understand, do your research and do your study. If you don't have an understanding of what they're going to do, sit on your hands for the day, step away. But if you believe and you understand what's happening, and like a lot of people, you knew that a quarter point was coming in, that's a great chance for you to wait. And I've always said to everyone I've talked to about trading around numbers, I will admit, I love trading numbers because it presents opportunity, but there's going to be two moves that happen with every number. And I can tell you over I'm going on 15 years or so in trading, anytime a number comes out, there's an initial emotional reaction, right? There's emotional reaction that comes into play. And then there's the reaction to the emotion, which is well thought out and a methodical move. And a lot of times, I would say a majority of the times over my career, I've noticed that reaction to the emotion is when the market starts to creep higher.
Yeah. And you're also dealing with the whole, you mentioned a little bit, just like giant players on some of these initial moves on it. People's goals in the market are never necessarily aligned. Like, we all want to make money, but that might not be the purpose of why someone's doing it. Now, they're not trying to lose money, but they might be trying to hedge something. And when you get into these interest rate moves that affect things like mortgage dealers and banks and stuff like that, they have stuff that they just need to do and get hedged based on whatever the interest rates at. And those are going to be moves that you might not be able to make sense of. So that's why, like Dan said, I like to trade around numbers as much as I can, but the Fed was always the one that I would wait to let things shake out a little bit before I dove in there whole hog. Now, the future is always what the issue is. Okay. So as I mentioned, the next 6 meetings we're looking at, ideally, according to the Fed, a quarter point each time. Now, remember, we're going from like 0 interest rates. Interest rates are a good thing. We need them, right? Everyone is just yammering all the time. We need to cut the interest rate, cut the interest rate. We're at 0, man. Like, we only raised it to, interest rates are still incredibly low, right? They raised it. The Fed funds rate is between 0.25 and 0.5%. And even if we do 11 raises, we're only going to be somewhere in the 2s. Okay. And even 2 to 3%, not a really high interest rate. Back when we were really fighting inflation and things like that in the early 80s, the Fed funds rate was 15, 18%, something like that.
It's funny you mentioned that. When I was talking to my dad about this last night. He's got a little history when it comes to trading interest rates. I asked him, and he goes, I go, what do you think? What are your thoughts? And he goes, well, I remember when I bought my first house, my interest rate was like 22%. And I'm thinking to myself, I'm like, man, no matter what we say about what's going on, it's a heck of a lot better to borrow money now than it was, 40 years ago when he was buying his first house.
Yeah. There's a give and take to everything, people always, possibly because there's just like a real estate media industrial complex too in the United States, where everyone's always talking about, is this the right time to refinance? Is this the right time to buy a house? Is this the right time to sell your house? There's a million articles written about that. I think the dirty truth is that it's just a give and take. There's no free lunch. As interest rates rise, the price of real estate goes down. And it's kind of that's just the way it works. If interest rates go down, you get a cheaper mortgage, but you pay more for the property, So there's no.
And people are always in that pickle. I'm in the same boat right now. Like, I could sell my house. I could do pretty well on my house. Interest rates are still low enough that I could borrow pretty well. But the next thing I do, I'm paying up for the next house. And it's always a give and take. It's never a perfect situation. The stars are never going to align where you got low prices and low interest rates and easy to borrow. And, you can sell your house at a premium. It just doesn't work like that. So there's always a give and take. Jack, I got a question for you. You're the in-house economist. I mean, I'm not saying you're an economist, but you're the closest one here. I would look to a Top Step to talk this type of stuff. We have inflation that's high. We all are in agreement that raising interest rates is going to help the inflation numbers. if they continue to raise these rates, Jack, what's going to happen? Is there potential for expedited recession? Like, are we going to lean towards that because it's going to get more and more expensive to borrow money? And we're going to cut this inflation because inflation is going to continue to rise because people aren't spending money. What's going to happen there?
So the big yawning chasm in between like reality and what we have now, and sort of the $1 million question, but really like the multi-trillion-dollar question, is that, okay, right now we have this inflation. The CPI came out at 7.9. Now, I'm not trying to suggest that like a transitory thing. I'm saying that there is cognitive dissonance going on, because as of today, the rate on a 10-year treasury, the yield is 2.1%. Bonds, as we've discussed before, are smart money, meaning it's institutional. It's people, sometimes the people that know F up, we've seen that many a time, haven't we? But right now, you have a situation where the CPI is 7.9% annualized and the yield on a 10-year is 2.1. One of those two things is wrong, or not wrong, but we'll have to adjust, right? If for the next 10 years, inflation was going to be 7 or 8%, there'd be no market to buy treasury bonds with a 2% yield. You'd be locking in a 5% loss a year, which smart money shouldn't do. Okay. This was like a test balloon by the Fed. They wanted to do a quarter point and see if the market dumped, right? And it didn't. So they'll continue to do this and raise it, because the way that you fight inflation is by raising interest rates. Now, in the traditional model, higher interest rates makes it tougher to borrow, companies don't expand as much, and it hurts employment. Our employment's super low, and I would go so far to argue that we focus too much on unemployment beyond its natural level in this country. We have a bigger problem with labor force participation for many reasons, structural reasons. There's our labor force participation rate, the people that are actually in the workforce, has gone down. But we're at what, 3.8% unemployment? You can't go too much lower than that, because there's such thing as that's not efficient either. There's a thing called the natural level of unemployment, right? People should be changing jobs. People should be unemployed from time to time so that they can move around and move from one thing to the other, right? I don't think 0.25% or even 2%, because remember, like now we get into the trading advice. I wouldn't completely go hog wild on this yet, because, just a couple of years back in the last tightening cycle, interest rates got up to 2.5% or somewhere around there, and we were at the same level of unemployment we are now. So I don't see anything yet suggesting, there's a lot of people still looking to hire and stuff like that this alone could cause a recession. I would be worried if the inflation, I'm still watching that CPI, gets carried away, but I don't think just raising interest rates is something that, once again, it's like the financial media complex where hedge funds and stuff and people that go on CNBC, they always want lower rates so they can borrow more money and leverage it up, right? I mean, it's no fun for them when they have to pay more to service their debt, but it doesn't really affect me that much, to be honest.
No, and I think that's the thing we got to think of here too, right? Like, yeah, people that are trying to borrow money for servicing debt, investment, buying more property, things of that nature, you're going to see that affected. The everyday American who owns one, maybe two houses, if they've got a vacation house, right? Or a cabin somewhere, you have one house. You're not looking to go out there and borrow these massive chunks of money of couple $100,000 to pay for your home. You do that once, maybe you refinance a couple times throughout the ownership of that house. If rates come down, or if things change, you create equity in the home, right? You can do little things there, but I think for the most part, it's not going to have this drastic effect, which I think I've seen from a lot of people. A major concern, just like, oh man, well now it's going to be more expensive and everything's going to, like you said, it's 25 basis points. It's 0.25% adjustment. It's not huge yet. It's still very viable to go out and borrow money.
Right.
It's not a bad thing.
And just to say why I know because most people think about the interest rate through mortgages, we always think of it as a bad thing. But you can see how raising interest rates puts a damper on things like bubbles, right? Because where bubbles really accelerate is when people borrow cheap money to, say, do margin trading or to lever up and stuff like that. And sometimes it's helpful to make that harder to do, right? So it's not all a bad thing. Now, you as the trader looking forward, I would say look at the dot plot. So the Fed releases what they think the interest rate is going to be going forward. Now, here's your heaping pinch of salt on that. It's always wrong. Okay, so why am I telling you to look at something that's always wrong? It's hilarious. You can go online and search for past. They layer past Fed dot plots from every meeting across what the actual interest rate is, and it's hilariously wrong. I have no doubt this one will be wrong too. But it's still important because that's what forms the expectations. And since markets are all about expectations, you're looking for deviations from that. So if at the next month meeting, right, when you see something like, if it comes out 0.5 raise instead of 0.25, and this will be influenced, just keep an eye on that CPI number that comes out, I would steer clear unless that's another one of those things where I would back out, because you're going to see a big move off of that. That's going to be a little bit confusing. I'm 99% sure that stocks are going to tank on that, but the market will always find a way to make you wrong when you're trying to be smarter than it. But that's kind of my thought. What are you kind of looking at, Dan, as far as signs going forward for?
I'm going to pay attention to minutes pretty closely. The Fed minutes, that's going to be an important one for me. CPI, I don't think there's any question around that. Ideally, we want to start to see CPI month over month tightening up. We're not going to see it year over year as closely, but with this change here, but maybe month over month, that's where we'll see a little bit of a change there. If we're seeing a decrease in month over month, that may mean that the Fed's going to be a little bit slower to increase these rates. If we're seeing continued inflation continue to increase, that's where you got to pay attention in 6 weeks from now. If CPI, if that inflation's continuing to rise, they may come in and have to do a little bit more drastic move. At that point, that's when you have to take a day like today or a day like yesterday off. The FOMC, when they're coming out with that statement, take the day off. I can promise you, as an outright trader, it's a dangerous time to be involved because you're not creating hedged positions. You're not spreading yourself out. You're not trading spreads. You're not trading butterflies. You're trading outright futures. It's a difficult place to be in when there is the unknown. When you're waiting for that information that, hey, it could be 0.25%, it could be 0, or it could be 0.5% coming out. That's when you have to be patient. I still strongly recommend any outright trader staying away from those numbers, unless you're trading a market that's not affected, which is a rarity when it comes to FOMC. Fed basically inflicts pain on every market. And you have to be cautious of that. So I'm really going to pay attention to CPI month over month, as well as the minutes. Minutes are going to be important to me.
Yeah, if you're doing stuff like swing trading too, just make sure, maybe this is, I'm saying maybe it's obvious to a lot of you out there, but just if you're holding a position for a week or a couple weeks, pay attention to not only where you're getting in, but like where the Fed meeting falls during that too, because that's sort of you're always taking risk when you're holding a position for a longer time, but that's sort of the one spot where I would be kind of worried about. This is going to, whatever you're looking at, that's going to be a little, unless you're just purely speculating on the Fed or anything else, more power to you. But if you're just going off of levels or something like that, I think that you got to avoid that number.
Yeah, I don't think it's much of a question. And I can go back to like right when I first started at Top Step. I'll tell you, the first month I had been at Top Step, our risk manager was out. I had to fill in for him, and my history of trading Fed, that was a high volatile time where I came from. And I remember looking at our marketing team at the time and saying, hey, we need to get an email out. This is a big Fed number. I know we're not talking about it. We weren't as vocal 5-6 years ago when I first started at Top Step like we are now. We didn't have YouTube. We didn't have videos. We didn't have a podcast. We would send out random emails. I was like, we got to get an email out ASAP. Like, we need to make sure people aren't trading this. We need to make sure people are protected around this because it's such a dangerous number. And that was 5-6 years ago when it really wasn't as big of a deal. We were kind of, the conversation about raising rates was out there at the time, but it wasn't, drastic. It wasn't a major concern, where like now it's a little confusing. Like you said, there's a potential. We know that they're going to raise them, but how much are they going to raise them? We got inflation happening, which wasn't a thing 5-6 years ago. We got a whole lot of other extenuating circumstances now that we didn't have 5 years ago. And I still remember saying, we need to notify everyone to be cautious of this.
Yeah, it would make me sleep a lot easier at night if me personally, I think that the raising is ultimately a good thing. I'd sleep a lot easier if we could get up to, a 2% Fed funds rate or something like that eventually, just because then you have room to cut. What worries me now is if something were to happen, and you never know what that's going to be. Like, none of us knew COVID was going to happen, but we were at, 2.5. Oh, yeah. Oh my God. I'm in Twilight Zone. I'm the only person that knows this. Go back in time and tell everyone. What year is it, Dan? 2020. Right. Yeah, it's March 2020. Oh yeah, we're a 2-year anniversary in a week of the low of that. But we had room to cut the rates if we needed to. It's now you have to get a little bit more if you're already at zero, and that's how recessions can be kind of exaggerated too, is there's nowhere left to cut. So if something were to happen and we needed it, you'd have to get exotic, have to start, I don't know, buying
paying
stuff
people
up.
to pay people to borrow money.
Yeah, that's the thing. I think that happened at like Switzerland and stuff like that. I think it'd be tough for the United States to go into negative interest rates. Plus, that starts a spiral of it's not good when money is devaluing like that, pretty much. So
I got good credit. I'd be happy to go get paid to borrow money.
Yeah, that would be nice. Yeah, so that's sort of the thoughts on that. Just watch the dot plots, watch the CPI numbers, and besides that, I think you just kind of got to what's it called? You just got to kind of be one with the universe. Let it go.
Yeah. Memory like a goldfish with some of this stuff too, right? Like, if you weren't feeling it, if it wasn't there, if you missed the move, don't relish on it, kind of move forward. We're going to continue to see volatility. I don't think, I think we've been saying this for the last 3 or 4 years, like as we approach into summer, which is right around the corner, 67, 68 degrees here yesterday. So we got summer kind of around the corner. We always have talked about historically summers where things quiet up. Now, the last few years, we've really basically said, don't expect that. I think the same is going to apply here this year. Don't expect things to slow down. Volatility is going to there. So don't waste what you have on now, because there's going to be continued opportunity down the road. So continue to look for it. Don't feel like you have to be in a Fed day or these major releases. CPI, Jack, I think we've both beaten that one pretty good. CPI is the number to watch.
Yeah.
I don't think there's a number out there that's more important than CPI right now.
I mean, these last couple of days have sneaky for like stocks just been the biggest rip upward in a long, long time. I mean, that's some serious movement here. So I expect the volatility to continue for the foreseeable future, because that's the world we live in, everyone. Just a lot going on. So enjoy the little things, Dan.
I can do that.
Yeah. Well, thanks for having me. I guess I'll do the sign off for now, Dan. For everyone out there, thanks for doing it. Fill out your bracket. Oh, I forgot to say there's prizes too. We're giving out like free combines and stuff like that. So that's something you might be interested in. And even if you're not, hope you have a great St. Patrick's Day. Luck of the Irish to all you.